uh, start with a phrase I've been thinking a lot about. Markets often defy conventional wisdom. And the idea of this presentation this week is to talk a little bit about that and some of those thoughts that we've had in markets over the last, especially coming from investors over the last years and decades that have essentially not turned out to be great calls. And usually the most this is why investors shouldn't be contrarian for a contrarian sake, but instead looking for enough macro and value reasons to be taking that very different opinion relative to what conventional wisdom is. One of them would be the gold market. Who would have thought that gold would rise with interest rates rising? I mean, I would say that 2-3 years ago, that would have been unthinkable. And a lot of people challenge the thought of gold markets moving higher because of the risk of interest rates. That's certainly has been one of them. And there are many others that kind of fall into this picture. And usually you have a few sectors that tend to lead the market on one cycle that then in the next cycle are actually the ones that tend to lag, or at least not lead. And the laggers of the prior cycle are usually the ones that could be the ones that potentially lead. So it's called the rotation that we tend to see across sectors over time. That rotation is real. It often happens after 5-10 years. And usually it's caused by success. You have the success of a business model in a certain cycle that attracts capital, inflates valuations, and then smart investors get out of the position after they made a lot of money. And then those that are late to the party end up holding the bag. And then we see a crash in markets. And then the market starts over again with the leadership that changes over with new sectors that will be leading the way. So let's go to one chart that is interesting. If we go, there you go. And you can see here, one very conventional thought not too long ago was that China was going to take over the world, that the Chinese yuan or the Chinese currency was going to become the reserve currency. And Kevin and I used to write a lot about the Chinese economy. And instead, even from a market cap perspective, the idea was that China was closer to becoming this new power rather than the other way around. Instead, we've seen sort of an implosion of their own economy through many reasons that we actually express our opinions back in the days and actually made money on in our portfolios, which was related to the real estate bubble and the overly the over infrastructure developments that we've seen over the years in China, the banking crisis. And one thing that is still hanging in there that we think it could happen is the Chinese currency devaluation. But you can see here that from a total market cap to global equity markets basis, you can see that the U.S. is now about 47% of the global economy. That is, probably unfortunately, this chart doesn't go back even further, but I would suspect that this is probably the highest, probably close to what we saw back in the tech bubble as well. We know that most of the companies in the U.S. are very international. That's why I like to look at that relative to overall market cap. And you can see here, by the way, there are other emerging markets like Brazil that don't even have a digit in front of it because it's basically less than 1% of the market cap of the global equity market. And those are the ones that are, to me, present an even better opportunity. So let's go to the next chart. Now, if we looked at Warren Buffett's favorite indicator for valuation, which is market cap to GDP, and we take a step back and also add equity risk premium, which I think it's a very important way to measure valuation, or I should say, just how much you're paying for the potential premium of a certain equity market. In this case, it includes the earnings yield of a market for each of those countries in the screen. but also it takes into consideration the cost of debt, meaning the interest rate environment that those countries are in. And you can see here clearly that the US is by far the most expensive market in global equity markets today, from a market cap to GDP perspective, but also for how low the equity risk premium is in the US as well. You can see other opportunities. Some of them are maybe we should call uninvestable or more difficult to deploy capital into. Turkey, Russia, those offer very low market cap to GDP levels with actually very high equity risk premium. And then you have the more, I guess, easier ways of expressing your view in markets, which is, in our opinion, it would be South America. You can find a lot of those countries in the bucket in the far bottom left would be Brazil. You can see Chile, you can see Mexico, you can see Peru. All those countries actually fall into that bucket. Some of them have lower market cap to GDP, still have low equity risk premium, and some others like Brazil would be more balanced, or Chile would be more balanced. That look attractive in both sides. And you have some other outliers like South Korea that don't have as much of a high market cap to GDP, but also a very high equity risk premium. And so you can see where sort of the, I hate to use a Jim Cramer quote, but there's always a bull market somewhere. And that in this chart, you can sort of look for those, and you got to dig in further to see what the opportunities are. But certainly you can see here, there are things that are really cheap out there and very undervalued. Some of them, for most of them, have a reason for it. But this whole concept of buying something low and selling something high, it's much easier said than done. It requires a sort of psychological, comfort to be able to buy something that is against the crowds. And I think that it would be unthinkable to see perhaps the leadership of the U.S. Falling away from other economies, in which I think this is very high, actually highly likely, particularly coming from emerging markets with resource-rich economies. And I think this chart is just another supporting evidence of how potentially we could see that shift of leadership. And even from a prior chart, you can even maybe see that market cap to global market cap from the U.S. to reduce drastically over the years, mostly driven by not only a potential decline that Kevin was referring to, but really as well through the rise of other economies that could do much better in this environment. Let's go to the next chart. And you can see here another unthinkable, and funny enough, we do a macro meeting every Tuesday in which we had this chart, and Quentin doesn't usually participate on those because he's busy with his other things, but he also sent this chart to us, and I thought it was interesting because we had the same idea. But you can see here in the 70s is basically looking at a stagflationary era, and you can see correlations of assets. It's a really good way to sort of pick and choose asset classes that perform well or didn't during the 1970s period. And you can see clearly that gold not only performed well throughout the whole decade, but was consistently a good annual performing asset class during that period. You can also see commodities did very well in green, following gold in many ways. And I would say that the other part of it that is interesting is if you look at the bottoms of this chart, there are many times in history where technology companies showed up as a part of the market. And by the way, technology companies were not truly as frothy as they are today in terms of valuations. Therefore, one can make the case that coming up from much higher prices, as Kevin was alluding to here in his presentation, that maybe the compression of multiples could be even more severe in the days like today. So let's go to the next chart. And I think this is kind of ties with this idea that I think a lot of people have sort of acknowledged that we're living in this new era, of interest rates being higher for longer. I think most people would agree with that thesis, but the markets, parts of the markets are behaving that way and other parts aren't. And I'll explain a few of those. The ones that are participating in that new era world is gold actually performing better than treasuries. You're seeing sell-offs of treasuries with gold rising. Well, that's a unique environment that we tend to see during stagflationary eras. You can also look at how some of the value companies that we haven't seen perform well in a very long time, like energy companies, is starting to take the lead in the last 2 years or so, or not the prior year, but 2021 and 2022. Energy had such a strong performance, and that was very unusual for the type of market of a disinflationary environment that we've been in for so long. We're seeing other commodities taking charge. That sort of rotation of commodity prices, where you tend to see, now it's cocoa, but it used to be orange juice, and at some point, not too long ago was gold, making new highs, and those things keep rotating. And we had the silver squeeze, and now silver is my view poised to do that again. You have copper now, so you can see that there's a rotation happening, and then you have others like natural gas prices, which I will touch on this here in a minute, basically trading at historical low levels. And so, but those things keep moving, and you can see that that's really this new era of higher interest rates, but also higher inflation moving forward. But then when I think about that, and I look at, if we're going to see a world of higher interest rates where, think about a company that has a junk rating. A company that has a junk rating, back, 5-7 years ago, we used to borrow money at about, 4 to 5% interest rate. That was a great environment. That was the ZERP environment, the near zero interest rate policies that we've had across the globe for many years, that really helped those junk rated companies to be able to borrow money for nothing and continue to run businesses that are very, not profitable. Now, in this environment of high interest rates, if you just look in nominal terms, you can see clearly that interest rates for junk bonds are now at around 8-9%. That's an average, right? And if most companies, some other companies are actually having to borrow capital at around 10, 12, so double digits today. And if you think about in that environment, how in the world have we repriced the cost of debt, but have we not repriced the risk of default? Because just logically, if a company is borrowing money and interest rates are rising for a while, 2 to 3 years of a rise of interest rates. I mean, look at this chart. The red line has been rising steadily for the last 3 years at least. If you consider that as something that is, maybe moving forward, we'll continue to see that. How have we not seen the same impact in other things like credit risk? And so now you're looking at the other line there, which is looking at the credit spreads, which if we go to the next chart, you can see credit spreads today. And you can look at this in many different ways. You can look at different spreads. In this case, I'm looking at the corporate BAA versus the 10-year yield. And so what does that mean? It's basically you're looking at the spread between a bond from a corporation relative to a risk-free government security. And you can, so basically spreads are less than 2%. It's about 1.5%. So you're basically, in order to buy that corporate bond, you're assuming that there's basically no risk essentially relative to risk-free rates or the U.S. government securities in a world like today. Now, this may sound unique, and it is because it's one of the lowest levels we've seen in history. But if you notice in the first panel of this chart, and I showed where other periods where we saw this period of suppression of credit risk itself, you can see that actually that tends to coincide with periods when the Fed is hiking interest rates. And so the Fed starts hiking interest rates. That causes interest rates of risk-free rates to increase, right? And then that ends up causing a suppression of credit risk priced in the markets that essentially at some point creates some sort of issue, which in each of those arrows that I have there, had different things that caused those problems. One of them was the global financial crisis or the tech bust, and others. And eventually, it causes the spread to really widen, and so you see investors are starting to price that risk, increase drastically. Now, if you ask me, where if we're living in this new era of inflation staying higher for longer, structural problems with consumer prices being higher because of deglobalization, the labor markets, you can talk about the fiscal spending, all sorts of things creating this. And and the prior chart, if you look at that red line, if that is the right trend that we should be watching for, then I believe that this chart right there is massively mispriced. And or essentially, if I'm wrong, then it means that we're going back to a disinflationary world. My view. I don't think that that's really what's going to unfold in the next decade. I think what's likely to unfold is that inflation will be sticky, interest rates are going to be higher for longer, inflation will be higher for longer, and the risk of default is going to have to be priced more appropriately, which is not at a 30-year low. And so that means Crescat is short junk bonds. That's one way to think about it. Let's go to the next chart. And so think, now if you consider a little bit more about this idea of cost of capital, and cost of capital, you can break it down in two ways. It's not just interest rates. Interest rates is one measurement, but dividends is another one. We saw Google was very small, but Google actually announced a dividend yesterday on their earnings release. We've had a few airline companies, and I always joke about this, but if you're in a higher cost of capital environment when airlines, one of the worst margin businesses in the world, are starting to pay dividends. That means they're being pressured by investors to actually start, even the miners. I mean, we're even seeing the miners paying dividends in a degree that we haven't seen before. That is, again, pressure from not only competition of other bonds and other instruments out there that are yielding something, and in order to attract capital, those companies need to start either paying dividends or doing buybacks. And so, interestingly, if you look at throughout history, dividends during inflationary eras basically made up close to over in the 40s was 67, in the 1970s was 73% of the overall return in equity markets came from dividends. And so are we entering an era that will look like that? I think so. I think that's going to be highly likely, especially because overall return from equity markets are going to be highly unlikely to be the same high growth that we've seen in returns especially over the last year or so. I think that's highly unlikely in this next decade, and so growth may actually come from things like dividends. And you can see the NA there on 2000s because it's because the return was negative, and so the dividends was 100% dividend. It wasn't an inflationary era. It was really because we saw the opposite of an inflationary era, but not because companies are paying dividends, as you can see. It was really because the decline of the actual returns of financial markets. But let's go to the next chart. So now, this is a good picture of yield curve inversion going back all the way to 1920s. I like this chart for many reasons. Number one, it reminds me of the scenario that we study quite a lot here at Crescat, which is 1973-74, during that stagflationary environment where we've had commodities actually do very well on the back of equity markets declining. But we've also had a period where there was a steepening of the yield curve. And you can see here that every time the yield curve was basically deeply inverted, we've had an aggressive movement to the upside. And if you ask me, I think that we're getting either close or in the process of that movement on the upside. In fact, if you go to the next chart, you can see in a closer look of 2 to 3 years, you can see that the 2 versus 10-year yields, 30-year yields are starting to move to the upside. And I think this is just the beginning. I think it will accelerate as we see this moving forward. Now, more importantly is the fact that an inverting process of a yield curve also coincides with a recession, is also a recessionary indicator for the economy that we should be watching for, and knowing that we've went from whatever 7 cuts priced in the Fed funds rate to now almost no cuts for the year. I guess 1 cut in December, in November. To me, it seems a little complacent. The potential risk, especially coming from those signals that we have in credit markets that, by the way, never failed before, all the way to the 1920s, never failed before. And then on top of it, I just pointed out the whole point about credit spreads, how the risk is mispriced. And as we see that moving, I believe that that's also going to be aligned with the steepening of the yield curve too. Let's go to the next chart. And you can see here, interestingly, the correlation between the markets now. So if you look at there's 2 types of S&P 500, or there's more, but if we just look at the 2 types here, market cap weighted versus equal weighted, and you can see clearly that the correlation between the 2 are one of the lowest that we've seen in history. Now, if you look back, essentially, all the time we have this, the breakdown, or I should say, a leadership that is composed mostly by the mega cap companies, which is the case with market cap more driven index. And you see the equal weighted. I mean, just take a look at the Russell 2000 for the last 2 to 3 years. It is a complete different picture of the NASDAQ. In fact, that is down year to date already. And also, I should point out, for the last 2 years, it's gone, basically down relative to NASDAQ going up so much. And so when you see that rolling correlation declining significantly in this case and becoming weaker, I would say that that's usually aligned with some sort of issue, and that's because of this the breadth of the market is starting to show some levels of weakness. And so this is another sort of indicator to see that things are not as healthy as they may look like. Let's go to the next chart. Another correlation that I often talk about is this correlation between S&P 500 and treasuries. And, I talk about this new era environment, the new era of interest rates being higher. Well, what that changes is also the correlation between these 2 asset classes that are probably one of the most important ones out there, because most traditional investors are allocating capital every day into these 2 asset classes because they hold what's called the 60-40 portfolio, 60% equities, 40% fixed income. And so, but the interesting part about this chart is that you can see that this correlation was also positive back in the 1970s. And we went through a period here that we call the golden era of 60-40 portfolios that we think is ending. But if you go even step backwards and look even further in history, let's go to the next chart. You can see Bank of America did this chart going back all the way to 1945. And shame on me, I should have done that chart too. But you can see here clearly that this is the new era, really, or I should say the outlier really was the prior decades. I mean, it's normal to see bonds and equities having a very strong positive correlation throughout history. And so are we back to that normal era that we've had in the past? And I do think that's the case. As we see the cost of capital, and people are ignoring this, cost of capital continues to, establish itself higher and higher. And again, not only we're not discounting companies appropriately, I think, because if your discounting rate is getting higher, then your present value of the business that is having all these future free cash flows should be lower, right? But for whatever reason, euphoric, speculative environment, call it whatever you want to call it, we're not seeing that yet. But ultimately, markets will come to gravity works at some point, and you start seeing we'll go back to a more of a rational environment. And so we're probably going to go back to a place where bonds and stocks are moving together, and also a place where those correlations will also cause investors to change how they allocate their own traditional portfolios. And so this is why we've been big proponents of this shift away from 60-40 allocations and considering other things that can be very attractive. I remember not too long ago, everybody used to say, you just got to buy T-bills and chill. Why even buy anything else that doesn't yield anything? Well, that was exactly the time when gold just had a massive movement on the upside and made everybody who was holding those T-bills for whatever 4 to 5% yield, not look as smart. And so that's what markets do to you. It's just, the certain things are usually wrong. So let's go to the next chart. Okay, so what's happening in Japan in line with all this is also really relevant. So we're seeing on the, Japan is an economy which I think China is going to go through what Japan is going through. But you can see here clearly in this chart that Japan is going, it's a very different environment Japan has faced over the last 20 to 30 years. Inflation expectations, which is driven by the markets, you can see in white, are rising at the same time the Japanese yen is devaluing. Now, you can say, well, this is very pronounced in Japan, but is it really just Japan? No, it's a global phenomenon. We're seeing this rise of inflation expectations with central banks not being able to tight monetary conditions as they wish. And so they're letting their currency go. And so therefore, we're seeing this global fiat debasement happening. And it's what's causing as well commodities to rise. So this is a phenomenon we should all be using as a model for what's likely to happen here in the U.S. By the way, if you look at the BOJ assets today, is about 130% of relative to market cap to GDP in Japan. The U.S. is close to 30%. It's actually lower than 30%, about 25 to 30%. So if that's a roadmap for the U.S., boy, we've got a long way to go here. There's multiples that we got to change here in terms of how much the Fed assets need to change relative to GDP in the U.S. Obviously, we know that also Japan carries a much higher leverage today in their economy relative to their GDP. But I think we're probably going to the same direction. I don't see that reversing anytime soon. Let's go to the next chart. Okay, so what's happening now as well in line with this inflationary thesis is that you can see that global house prices have begun to rebound in a lot of places. You can see Australia now, it's up 9%. You have US, you have New Zealand, Sweden, Canada is still lower, but all of them are starting to rebound on a year-over-year basis. Well, I think central banks will be looking at it. And it's funny enough that Europe or the ECB is starting to talk about already very seriously about cutting interest rates, changing their tune in a large way. The only one moving in a different direction has been the BOJ, but the BOJ is ahead of the curve, and they're just basically facing a currency crisis, and therefore why they're having to move. But this is a problem. Again, it's a global phenomenon, and it's important to see that when house prices begin to rise again, because house prices are another form of hard assets too. So it's important to pay attention to that too. Let's go to the next chart. Now, one, I think, opportunity that the market is presenting to us, again, it's easy to talk about buy low and sell high, but here is one way to think about buy low and sell high. Natural gas prices are hitting, retesting levels that we've seen in the prior 7 major bottoms of this commodity. And now I can come up with a few reasons why natural gas should continue to move lower. But from a risk-reward perspective, this is looking really attractive. So we made a position. We're long natural gas prices at Crescat on the global macro fund. Let's go to the next chart. And you can see here, those are the changes that we've seen in the past of natural gas prices and this sort of performance we've had when we hit those lows in the past. And you can see some crazy numbers there. And I'm not saying we're going to see those numbers. I just think it's important to look back in history and see that this is a very volatile commodity and it for a reason as well. But also I think it's presenting an opportunity for investors that understand that level of volatility too. Let's go to the next chart. And one thing that is important was Toby Rice, which is the EQT, one of the largest natural gas producers in the U.S., was talking on CNBC the other day. And he was basically saying how this AI demand that is likely to drive electricity consumption and so forth is also likely to drive the demand for natural gas. According to him, well, we all know the LNG idea, right? This divergence between global prices of natural gas versus natural gas prices in the U.S. It's a huge gap. And the main reason for that is because our LNG ports, and also when those are functioning the right way, and we're actually sending LNG through, to the world, we're probably going to see those prices converge at some point. Now, for many reasons, we haven't seen that price convergence just yet. Now, just from that perspective, you would probably increase the demand for natural gas by about 15 BCF per day. That's according to Toby Rice. I'm literally paraphrasing what he said. The second thing he talked about, which I thought was even more interesting, is this AI revolution is likely to increase the electricity consumption by something equivalent to 15 New York cities. It's crazy. And according to him, that would be very similar demand for natural gas that would actually increase from the LNG construction and so forth to converge the prices, which would be another 15 BCF per day as well. So those are two things to pay attention to. Next, go to the next chart. And it all kind of falls into this idea of the infrastructure spending that we're seeing. Infrastructure spending caused by the reshoring, deglobalization. We've had this chart just showing you how much we have passed in our acts that have been passed already by the government in order to be spent. And it's close to $1.7 trillion, which is completely dwarfs what we saw, coming out of the World War II in terms of the rebuilding globally, not just in the U.S., globally. It's about 3 times. This is all inflation adjusted before somebody tries to murder me. It's all inflation adjusted numbers. It's kind of, it blows my mind. There's a reason why commodities and metal prices are moving higher. And it's crazy to me, because when you go to the next chart, conventional wisdom it still thinks that the miners won't make money. When you think about how the miners move, well, fundamentals matter. And you can see clearly in this chart, free cash flows and prices of the miners. It's the same chart. I mean, if you just really have to understand the fundamentals are going to improve or not in this environment where gold prices are trading today, copper prices, zinc prices, silver prices, and which we think are going to be trading even higher. What does that do to those margins that we're seeing today? It's not like the cost structure of those companies are, rising the same pace of the metal price in the last, call it 6 months or so. So I believe that in this case, the white line of this chart is poised to continue to move up, and that's going to cause the demand for the blue line, the prices, to move higher as well. Let's go to the next chart and go back to that idea of how markets tend to defy conventional wisdom. What is a conventional wisdom about the miners? Oh, the miners are terrible investments. I don't want to touch it. I like gold, but I don't want to touch the miners. I don't know an industry that's more hated than the junior mining industry. And then I looked at the mining stocks relative to gold, and they certainly have underperformed over the last 30 years or so. But they're so close to, for me, a historical bottom here. I think they're much closer than people think. And this chart actually might become very meaningful as we see, as I was presenting, the idea of new sectors, new industries leading the way to the upside. I think this has a very strong potential of being one of them. Let's go to the next chart. And so one example of this is just looking at the relevance of the gold market in prior eras, 1920s, 1930s, 1940s, 1980s. And you can see today the gold market is very small relative to equity markets, bond markets, real estate, and so forth. And so, I would suspect that in a world where we've seen so much expansion of money supply and liquidity, ultimately drives hard assets higher, and gold is a big driver of that. And I think gold is going to be representing a much larger percentage of global assets as a whole in the future, and that ultimately should also flow into the miners as they present, in my view, the most asymmetric opportunity across all these things. Let's go to the next chart. I'm almost done. The last thing I want to talk about is something I pointed out not too long ago. And, we had an interview with Kitco the other day, and something I said, and I want to say it again. If I die tomorrow or tonight, if I had one thing that I wish people would understand from me, at least, that I learned that I would pass it on, is that anybody can borrow someone's conviction, but or I should say, anybody can borrow someone's thesis, but nobody can borrow your conviction. That's a big difference. Why? Because every thesis will be tested at some point. Here's the Brazilian market. It broke out from a historic support. should call it resistance. It looks like it's off to a bull market. And guess what? It's now retesting that line again. Now, a lot of people have probably borrowed that idea, but the conviction comes here because now we're retesting that level. It's the same thing happened with the miners over the last 3 years. That conviction, no one can borrow from you. It's just, and that's what makes the difference of an investor that is opportunistic when prices decline and things get cheaper and you accumulate more. So to me, this is another one of those. I presented a thesis for Brazilian equity markets before many times. And to me, this is another opportunity. The sell-off that we've had recently is just, to me, is an opportunity for investors that have that mindset of long-term to reposition and accumulate more of those supposedly undervalued, historically undervalued shares, in my opinion.